Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about SHOUCHENG Holdings Limited annual report. SHOUCHENG Holdings Limited is a diversified investment holding company that offers various business services. At the core of its operations is infrastructure asset management, which involves overseeing and managing physical assets such as buildings, roads, and other infrastructure projects. In addition to infrastructure asset management, SHOUCHENG Holdings also provides private fund and asset management services. This means that the company helps clients manage their investments by making informed decisions about where to allocate funds and how to maximize returns. The company's portfolio of businesses also includes operating car parks, providing a convenient service for individuals and businesses in need of parking facilities. Furthermore, SHOUCHENG Holdings offers equity investments, allowing it to participate in the growth and development of other companies through share ownership. Overall, SHOUCHENG Holdings Limited is a multifaceted business entity that engages in various activities to generate revenue and create value for its stakeholders. Its diverse range of services reflects its commitment to providing comprehensive solutions to clients across different sectors. SHOUCHENG Holdings Limited maintains a market capitalization of $14 billion, broadly in line with the industry peer group. SHOUCHENG Holdings Limited trades at a higher price-to-earnings ratio of 42 times and a higher price-to-book ratio of 1.24 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The balance sheet appears very conservative, with liabilities representing only 28% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has increased on average, but the growth is not consistent year over year. This may indicate one-off events such as asset sales or capital raises, rather than durable business performance. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The company have a dividend yield of 2.41%. The income statement shows that the company have been growing its revenue annually and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth for a company can be attributed to several key factors. Firstly, industrial funds investment in outstanding companies has been a significant driver of revenue growth, creating value for invested enterprises and enhancing asset efficiency. Additionally, the industry finance integration model has enabled early identification of potential risks and formulation of effective solutions, leading to increased revenue. The company's ability to capture excess returns upon asset appreciation has also contributed to its revenue growth. Furthermore, stable revenue and cash flows from premium assets have provided a steady stream of income. The introduction of innovative businesses based on static traffic spaces, such as VIP parking areas, valet parking, car rentals, charging stations, and car washes, has also generated significant revenue. The widespread adoption and efficiency enhancement of AI technology has further contributed to the company's revenue growth. Other drivers include unmanned vehicle dispatch service fees, robot charging and swapping/custodial fees, robot maintenance/OTA services, commerce/advertising, robot brand display, intelligent business docking fees, and unmanned vehicle operators. On the other hand, the primary drivers of revenue decline are largely attributed to vacancy rates and decreased parking space turnover rates. The reduction in property management fee paid by Guangzhou Bank has also contributed to a decline in revenue. These factors have resulted in a decrease in revenue for the company. Net income and profit margins. A changing landscape, the net income of various sectors has undergone significant changes over the years. In infrastructure sectors such as technology parks, consumer infrastructure, data centers, and clean energy, net income increased substantially. However, this growth was short-lived as it decreased in 2026 due to a property services framework agreement. profit margins have also experienced fluctuations. Initially, they exceeded 30% in several infrastructure sectors. However, by 2026, they had reduced by 5–15% due to contractual obligations. On the other hand, profit margins for operation service income increased from 20% in 2023 to 22% in 2024, while those for revenue from construction services under a service concession agreement rose from 18% in 2023 to 16% in 2024. The changes in net income and profit margins can be attributed to various factors. The decrease in net income in 2026 was likely due to the Property Services Framework Agreement, which may have imposed certain restrictions or obligations on the companies involved. Similarly, the reduction in profit margins by 5–15% in 2026 suggests that contractual obligations had a significant impact on the bottom line. In contrast, the increase in profit margins for operation service, income, and revenue from construction services under a service concession agreement indicates that these sectors were able to maintain or even improve their profitability despite the challenges faced by other sectors. Overall, the changes in net income and profit margins highlight the complexities of the business landscape and the need for companies to adapt to changing circumstances. The company's financial performance indicates a significant improvement in its ability to generate cash from its core operations. According to the latest figures, the net cash flows from operating activities have reached a substantial amount of $15.57 billion. This is a clear indication that the company is generating positive operating cash flow, which is a crucial aspect of any business's financial health. This achievement suggests that the company's management has successfully implemented strategies to optimize its operations and improve efficiency, resulting in increased profitability and cash generation. The positive operating cash flow also provides the company with the necessary funds to invest in growth initiatives, pay off debts, and reward shareholders, further enhancing its overall financial stability and competitiveness. The company's debt level and interest expenses have undergone significant changes between 2024 and 2025. While there are mixed results regarding the debt level, with some pages indicating an increase and others showing a decrease or no change, one consistent trend is evident. The total debt increased from HK $3.94 billion in 2024 to HK $4.04 billion in 2025, representing a 2.5% rise. In terms of interest expenses, there is a clear upward trend. Interest expenses increased by $120 million or 8.6%, rising from $0.4 billion in 2024 to $0.52 billion in 2025. This increase is also reflected in the interest on bond payables, which saw an impressive 182.1% jump from $19,088 to $53,995. However, it's worth noting that one page indicates a decrease in interest expenses, with a drop of $67,307 from $128,032 to $195,339. Despite this anomaly, the overall trend suggests that the company is facing higher interest expenses in 2025 compared to the previous year. Management is optimistic about the company's future prospects, citing accelerated earnings realization and medium to high-speed growth. The company aims to become China's premier fund management company, generating substantial returns within a prudently controlled risk boundary. To achieve this goal, management plans to establish 2 core funds with significant scale, focusing on strategic emerging and future industries, as well as asset restructuring. The company has also made significant strides in the REIT sector, achieving a systematic layout and in-depth participation across the entire value chain. In addition, management remains optimistic about Chinese infrastructure assets, despite recent price pullbacks, and plans to increase investment intensity in managed funds. The company is also building a comprehensive service platform for the robotics industry, advancing an integrated development strategy of investment plus operations plus ecosystem. Furthermore, management has outlined specific initiatives to enhance operational efficiency and cash-generating capabilities, including adjusting fees for property management services and determining fair value measurements for investments. Overall, management statements suggest a focus on growth, innovation, and strategic expansion, positioning the company for long-term success in China's rapidly evolving market. The company has a history of rewarding its shareholders through 2 key methods. Firstly, it has paid dividends to its investors, as confirmed by multiple pages in the document. This indicates that the company has distributed a portion of its profits to its shareholders on several occasions. In addition to paying dividends, the company has also engaged in share buybacks. This means that it has purchased some of its own shares from the market, reducing the number of outstanding shares and potentially increasing the value of each remaining share for investors. That concludes the financial summary for SHOUCHENG Holdings Limited. Feel free to comment below, and I will be happy to answer them when possible.